Boom. What's up? We are live. Yes. How are you guys doing? Today, as promised from my video yesterday, we are going to be discussing which is best for you, a VA loan versus an FHA loan. We're going to get a little bit more involved into those things, and you're more than welcome to ask questions in the discussion. Um, we're going to give people a few minutes to sign on, as well as we're going to do a share. Of course, many people are at home right now based on quarantine, but you know what is not stopping? The real estate market. The real estate market is not stopping. And as your trusted advisor and real estate agent of the Reid real estate firm in association with Remax Metro Cityside in downtown Atlanta, I'm here to assist you guys in finding your home sweet home. And one of the ways that we do that is that being your real estate advisor means that I'm going to be that one-stop shop for you. I'm going to, make sure that everything that you need is taken care of, that you're pointed in the right direction, that you have the right advice, that you're looking for what's in your best interest, not in the best interest of the brokerage house or the mortgage company or the banks or anyone of that nature, but ensuring that you are setting yourselves up for a brighter future. Many of you have seen some of my videos on YouTube and Facebook where I've discussed about getting your credit right, getting yourself in the proper alignment based on what you are trying to obtain in your life. And buying a house is one of those things. If you've seen my video on the 7 cures for a lean purse, one of those statements, one of those cures is to buy the home to which you dwell in, to buy the place that you live in. So buying a home is part of you building wealth. It's part of your wealth building, because once you buy a home, then you start building equity. And we know that if you got into my financial alchemy program, that money talks, but credit builds conversation. Credit starts conversations. And we have to be in a mode where we start conversations, because if you want to build a business, buy more property, build wealth, leave a legacy, you have to get into one of the first steps, which is owning the property to which you live in. So today we're going to have a comparison discussion of VA loans compared to FHA loans. Now, right off the bat, if you're not a veteran, you're not going to qualify for a VA loan. But that doesn't mean that this video won't be helpful to you, because in this video, you're also going to learn a lot about an FHA loan, so that when we do the next one where we're comparing a FHA loan to a conventional loan, then you'll already have a basis of understanding. You'll always have an idea. Okay? So let's go ahead and get started in this discussion, because we're not going to keep you long. I know you guys got a lot going on, getting your alignments, your spiritual alignments, your physical alignments, your financial alignments in order. So let's get started. As far as my YouTube page, this was going to originally be a live on my Homes for Sale Atlanta page, but that one is not eligible for lives yet. So go over and subscribe to that page so it can become eligible for lives, and I appreciate that. So VA loans versus an FHA loan. First, let's get an idea. A VA loan is a loan that is backed by the Veterans Administration. If you are a veteran, then you may qualify for a VA loan. If you're not a veteran, you won't qualify. If you are a veteran and whether you're active, whether you have been, as long as you are honorably discharged or medically discharged, you may qualify for a VA loan. A FHA loan is a loan that is guaranteed by the government, all right, by the federal government. So, and these FHA loans are designed to help people who don't have tier 1 credit, who have difficulties, not say can't, but have a more difficult time going to a bank or a mortgage company and getting a traditional mortgage in the first market, all right, not in the prime market. So that's what the FHA loans are set up for. And we're going to go over some of the criteria for each one of them, what they're purpose for. So in both situations, the type of property that you can buy with a FHA loan or a VA loan is your primary home of residence. If you're looking to buy a beach house, you're looking to buy a house in the mountains, a vacation home, an Airbnb home, whatever these are, you're not getting a VA loan or a FHA loan. This home has to be your primary residence. So it was not going to work any other way. So if you're looking for a secondary home, these loans are not for you. We'd have to look at other loan programs to get you involved in. And those other loan programs may require that you get higher credit scores, lower debt to income ratio, and we're going to cover those a little bit later on. Now, the first big difference, and the main thing that most people do know and understand about the difference between a VA loan and an FHA loan is the fact that a VA loan usually does not require a down payment. Usually, it doesn't require a down payment. Why is that? Well, if you're a first-time buyer, if you got your VA certificate and you're a first-time buyer, you don't have to have a down payment. If you currently have a VA loan, you will have to have a down payment. If you've ever defaulted on a VA loan, you will have to have a down payment. But even still, that down payment is usually 10% or less. So it's a 10% or less down payment that you have to have, meaning that if you're looking to get a $200,000 home on a VA, then you are going to have to put 10% down, which is going to be what? How much is 10% of 200,000? Come on, let's do some math. Anybody got the math numbers? Anybody know it? Right off the tip of their head, 10%, 200,000, 10% of 100,000 is what? Come on. See, all y'all are on here, but ain't nobody talking to me yet, so I'm going to ask y'all some questions that I already know the answer to. But 10% of 200,000 is what, guys? I mean, that's basic math. I know school has been officially closed here in Georgia today, this afternoon. So what is 10% of 200,000? Y'all are taking way too long to answer this question. None of y'all know? Y'all got calculators? I'm waiting. I'm waiting. Y'all not going to answer? That is so rude. Thank you. Thank you, Tara. 20,000. 10%. Thank you, Tara. I appreciate it. Over on YouTube. 10% is $20,000. So if you have defaulted on a loan before, on a VA loan before, then you may need up to 200,000 for, so 10,000 per 100,000 of the house that you're buying is what you're going to need. Now on a FHA loan is completely different. On an FHA loan, if you are, it's all based on your credit score. If your credit score is below 580 on an FHA loan, then you're going to need anywhere from 10 to 20% down. Anywhere from 10 to 20% down on it. If your credit score is above 580, then you will generally only need 3.5% down. But below that, so if your credit score is like 500 to 579, it's going to be 10% down. If your credit score is below 500, you're usually not going to get an FHA loan. But if you do qualify for one, they're going to want more than 10% down. But if you're above 580, which is not that hard to do, it is not that hard to get above 580. If you've gotten my DIY program for financial alchemy, getting to a 580 is actually quite easy based on, and it's going to be individualized based on what's on your credit. But below that, you're going to need a 3.5%. So what's 3.5% of 200,000? Come on, Tara. Let's see if you can break that one down for me. 3.5 of $200,000. We're gonna wait a little bit for that one. But so if you're looking to get an FHA loan, and if you think about it, if you want to think about it logically, then think $100,000, 3.5. That's $3,500. So for $3,500 for every 100,000 will equal what for a $200,000 loan? $7,000. Exactly. Thank you, Tara. $7,000. So if you want to, so that is a big difference. Now, if you defaulted on a VA loan and you are a veteran and you're looking to get a home that's $200,000, you're going to have to come out of $200,000. That's why, as a veteran, it's not always that you go and get a VA loan. If that's your situation, an FHA loan is going to be better for you because it's going to be better for you as far as the down payment is concerned. Instead of having to have 10% down, you can come to the table with a high enough credit score and only have to put 3.5% down, which makes it a lot easier for most people, period, to be able to have that, just that smaller percentage. And there are bridge loan programs out there there are bridge loan programs that will help you to get the down payment, even if you're getting an FHA loan. So there are programs that will, you can get it's not your first mortgage. The down payment will actually be considered your second mortgage on your home if you go and get one of those loans. Okay, so be aware of that. That if you go out and say, okay, I'm getting this $200,000 loan, but I don't have $7,000, I'm gonna go get a $7,000 down payment loan, a bridge loan, in order to get the house. The mortgage companies will accept that. They will accept that, but the primary mortgage, the $200,000, that will be your first mortgage, whereas the down payment will be on your second mortgage, which usually would have to be paid off in 7 years. So that is the down payment is not going to be long. What is the gain in this pandemic? Can you express that question in a little bit more detail, please? Like, why should you buy a house during this time frame, or is there a benefit to buying one during this time frame? Because right now, guys, I'm gonna go ahead and tell you, it is a benefit to buy a house now. To buy it now. Now is the time. Mainly because the bond rate has the mortgage rates at such a low. This is the lowest it's been since the 1970s. So this is the time for you to go and purchase a home right now. Right. You will have low interest, and the APR, everything is low right now. Trust me, as we come out of this, these rates are going to go up. They're going to go higher, and the market is going to shift. So right now is the time for you to go ahead and buy a house. That's why we're talking about this at this very moment. So we want to have that understanding of a VA loan compared to a FHA loan, or if you can only get an FHA, or might look at a conventional loan that's backed by Fannie Mae and Freddie Mac. That's a different video. So we're going to stay away from conventional loans today and just talk about FHA and VA loans. All right. Now, your credit score is going to make a difference between the two. Usually, if you're looking to get a VA loan, you need to have a credit score. Even though they don't tell you that there is a minimum credit score, on average, what you need to have to get a VA loan is a 620 credit score. So if you got a collection, one or two collections on your credit score, you can get those off. That'll boost your credit score. But before you pay off a collection, get a pay to delete letter. Make sure you get a pay to delete letter before you pay off any creditor, and do not make the deal of paying a portion of it and then they stop bothering you. Pay the entire debt, but get a pay to delete letter before you pay off something. You can get a 20-30 point boost on your credit score just getting rid of one collection. If you're not a member of a credit union, join a credit union, and we will do a video comparing getting your loan from credit union or mortgage companies or conventional banks later on. But if you're part of a credit union, go do a shared loan, one or two shared loans at $1,000, $2,000. And I did a video about that like a year plus ago, about how to boost your credit score by like 80 points or 31 points or something like that. You depend upon how you do the shared loan. And if you do it in the way that I show you how to do it in that video, you can get like a 30 to 80 point boost in your credit score in like a couple of months. And then that may boost you up to that 620 so that you can qualify for a VA loan. Now, for FHA, like I was saying, you start at 500. 500 credit score gets you in the door. But between 500 to 579, you're looking at 10% down. So if you want a $200,000 house, you need to have $20,000 in your pocket. But if you got $20,000, now I want you to think about this math. Think about the logic of this. Think about the logic. You want a $200,000 house, but your credit score is 500, somewhere between 500 and 579. To get this $200,000 house, you got to have $20,000 down, right? Now, if your credit score is 580, then that same $200,000 house, you only need $7,000 down. That's a big difference. That's a $13,000 difference. You can take that $13,000 and do a combination of shared loans, pay to delete letters to fix your credit all up, so that your credit score is above that 580 mark, and only have to put $7,000 down, but also you will be getting a drastically different interest rate with a 580 credit score compared to a 550, compared to a 530 credit score. So it's better to take that money that you will have down and get your credit right, before you go and take and put 10% down on a house. Utilize the money to fix your credit first. And that'll be your better, that's the better pathway for you. Now, of course, if your credit score is 620, and then on the FHA, once you're 580, you're gonna pay 3.5% down no matter what. Your credit score can be 700, it can be 840. You're going to put 3.5% down, but you're going to get a better interest rate. You'll get a much better interest rate. So, and then if your credit score is actually above 680, more into the 700s, then we're going to be looking at you compared to getting a conventional loan at that stage, because then you're getting closer to getting prime rate. You know, anything below that, like 715 mark, you're not, anything above 715, I should say, you're starting to look at getting prime rate mortgages. So when you see that the mortgage rate is like 4%, those are for people who got like an 800 credit score. They're getting 4%. If you're in the 600s, you're not getting 4%. Okay, you're not gonna get the prime rate. So because those prime rate mortgages need to be sold on the secondary market, so they are only generally given to prime people who have the higher credit score. But that makes a big difference in how you in your decision making, you know, and make a big difference. Um, Tara on YouTube says she bought her home in 2018 from the FHA with a 5.7 interest rate. Is that good or bad? Here's the good and bad of that. The good and bad of that is, what is the interest rate now that you would qualify for? I would seriously take a look into refinancing your home. If you got it at 5.7, if you can get it at 4.7 right now, then that will save you tens of thousands. I don't know how much your home was, but that will save you thousands of dollars over the course and the life of your loan. And in another video, we'll talk about doing an amortization schedule, which can save you a lot of money over the course of your loan. But you have to do an amortization schedule a certain way. You don't do to just pay an extra payment. There's a certain way you do it so that they are legally bound to exclude all that interest. So we want to make sure we're doing that correctly. But go find out what your interest rate will be, and then do an amortization schedule comparison, and that will tell you whether or not it's a good idea for you to refinance your loan right now. Especially if you can get a whole point off, that'd be great. That would be great. That would save you some money. And it depends how many years you got left on the loan right now. Well, you say you just bought in 2018, so you just started that 30, and if it's a 30-year mortgage, go check it out. Go check that out. So the next thing that we have, the next big difference that we want to compare, $137,000 was purchased. Yeah, but you only it's a 30-year mortgage, more than likely, Tara. You got a 30-year mortgage, I'm assuming. If you do, then you can save thousands of dollars if you can get a lower interest rate, even down to 5% compared to your 5.7, will save you money when you do an amortization schedule comparison. Matter of fact, there are amortization schedule calculators all on the internet. Do one of them for your 5.7 over 30 years, and then do one at 5% over 30 years, and that'll show you the difference in what you will be able to save. And that's what it's about. It's not always about saving money in the immediate, but saving the money over the long term. It'll show you how much it'll reduce that payment. Maybe you go, I don't know what your payment is now, but let's say your payment is $600. It's the difference between paying $600 a month and paying $450 a month, or $500 a month. Just saving that $1,200 every year will make a big difference in a lot of people's budgets. So let's take a look at it. The next big difference that we have between a VA loan and an FHA loan, and you got to be aware of this if you're getting an FHA loan, you definitely want to be aware of your mortgage insurance and fees. Even with a VA loan, there is no mortgage insurance that you have to get. Now, what mortgage insurance is insurance against you defaulting on your loan with the mortgage. So let's say you get a loan, and then 5 years from now, 2 years from now, you can't pay it anymore. You got to get out of it. The VA, what they do is make you pay what's called a mortgage fee. Oh, you're welcome. That makes you pay a mortgage fee. That mortgage fee is going to be a certain percentage it's going to be a percentage based on the price point of the home. And it's also based on your credit score. So it could be anywhere from 1.4% to 3.6%. of the loan on a VA. So, and it could be actually higher if you've defaulted on a loan before, or if you're carrying another VA loan right now, or if you have your credit is not that great. If you do have to pay that, let's say, and if it's like 3.6%, that's almost $7,000, like $66,900, $6,800, something like that. So when you get that VA loan, you have this mortgage insurance premium that's a one time of 6,000 some odd dollars. Now you can have that rolled into your loan so that you don't pay it up front. When I bought my first house in 1997, I had the insurance rolled into my payment. It increased my it increased my payment, and over the life of the loan, I wound up spending almost double the amount of that premium. But I didn't have I didn't have the money, to be honest. Just straight up, I just didn't have the money to be able to pay. It was, I think back then for me it was like 3,000 some odd dollars. I didn't have the 3,000 some odd dollars to pay it. It was rolled into the loan, so I wound up paying. And when it's aggregated over the 30 years, it wound up being like $5,000 that added to my total payment of how much I paid for this house over a 30-year period. Now I did do an amortization schedule, so I did drop a lot of that. I didn't wind up paying the whole thing, but normally people don't do that, so you wind up paying for it. Some people don't pay attention to it. Some people don't care. They say, "Oh, it's only another $30 into my payment or a $20 increase in my payment." But when every penny counts towards you building wealth, you want to be at least informed as to the decision, so you can make informed, so you make a good decisions about it. But that mortgage insurance is something that you don't have to have, but that fee actually accounts for the insurance on a VA loan. Now, the mortgage insurance, it's on your FHA loan, you have to have it. And again, this can be rolled into it. You usually have to make the first monthly payment of it. It's over a 7-year period usually. No, it's not over a 7-year period. Usually it's set over the life of the loan. But as soon as your equity in the house becomes 78%, then the mortgage insurance premium drops immediately, right? So it's gone. And then after that, what you can do is once you paid into the mortgage insurance to a certain level of payment into it, you no longer have to keep it. Okay. I have it written down here as to what that number is in actuality. Make sure I give you the exact right information on that one. Where did I write that? Let you guys catch up a little bit as I'm making sure I find it. Oh, once you have at least 20% equity within the home, then the PMI will drop. You can cancel it, but if you don't cancel it, it'll automatically do so once you hit that once you get to 78% equity within the house. So that's one way of doing that. But you just need to be aware of the fact that it exists and that you're going, one way or another, you're going to pay for it. You just have to establish how you're going to pay for it. And yes, it can be rolled into your loan, but now it's the decision: am I going to get this $500,000 house, or am I going to get a $400,000 house? Because the amount of the house and your credit is going to determine how much this mortgage insurance is. And those are factors that you have to consider when you're buying your home. Now, your minimum credit score, we already went over that one, so we understand that all these things are affected by your credit score. The next biggest factor and the biggest difference between a VA loan and a FHA loan comes down to your debt to income ratio. Now, this debt to income ratio thing throws some people off, because sometimes I've seen it where lenders have had people not just put down what your rent is right now, your mortgage, your car notes, your credit cards, but they also have them put in like How much do you spend in gas every month? How much do you spend in clothes? What do you spend as far as food and these sort of things? And incorporate that into their debt to income ratio, which is absolutely bogus. They shouldn't be doing that at all. So if you're working with a mortgage company and they start telling you that in this you're supposed to put down how much you spend in groceries every month, that doesn't count towards your debt to income ratio. Sometimes that's something that is done in order to give you a higher interest rate. So if you're experiencing that, then you're really dealing with more of a predatory lender, and you should walk away from that lender. This is why I don't tell my clients where they have to go, but I advise them on certain lenders to work with, certain lenders to go to. I give them at least three that they should go to and see what they are offered from these lenders. The ones that are online, these online lenders, I'm just gonna say I don't trust most of them. 99 out of 10 of them are not trustworthy. 9 out of 10 of them are going to tell you, oh, here's your pre-qualification letter, but a pre-qualification letter is not a pre-approval letter. So if you came to me as a client and we're talking, we're discussing things, and you come with a pre-qualification letter, I'm going to send you back to get a pre-approval letter. Because a pre-qualification letter, you can have it and you can go through the process, find a house, fall in love with the house. No, this is the house for you. Put a contract down on the house. It's getting ready for close, and then you're not qualified. You're not qualified. A pre-qualification letter does not. You're not approved, I should say. A pre-qualification letter does not approve you for a home. You need to get a pre-approval letter, and when you're getting that pre-approval letter, if they are telling you that you put your food down, how much you spend in gas as part of your debt to income ratio, that's a predatory lender. Walk away, because your debt to income ratio should only include things that you have a revolving payment on: credit cards, car notes, house note. That you can't put rent will be a question, how much you're paying in rent now. But that one is a little crazy with the formula, because they just want to see what you are affording now with your current debt to income ratio. But with a VA loan, your debt to income ratio can be over 41%. It's scrutinized a bit at 41%, but you do get that leeway of 41%. With the FHA loan, though, with an FHA loan, you can get up, they'll allow you up to 50%. Up to 50%. Now, why is that significant? It's significant because when you look at a conventional loan, and we'll do a conventional loan on a different video, when you look at a conventional loan, they are going to keep you more around the 30%, 33, 35% at max kind of rate. So the that 35%, that's for those prime. That's when you got that good eight something credit, 790 credit. So if your credit score is in that range, then, and you know you're getting ready to buy another house in the next 2-3 years, then what we would have to do is start working on getting your debt to income ratio down to in the 30s. All right, but for most people, we're not living that way. Most people, we're in that 600 credit range, low 700s. We're going to be looking at these the FHA and the VA loans. You have more in the ratio, but we don't, just because we have more room in the ratio doesn't mean we want to stay in the ratio. You still want to get that ratio down to in the 30s if possible. You want to get it down because that will also affect the interest rate that they offer you. The lower your debt to income ratio is, the better the better interest rate they're going to give you on the loan. And as I said before, just having 1 point of a difference is tens of thousands of dollars. So like Tara is going to go and she's going to see what kind of an interest rate she can get. But in the meantime, you want to look at your debt to income ratio and see if there's something you can drop down real quick. If you can put a large chunk of money on a credit card or anything like that to drop your debt to income ratio. So if you guys are looking at your credit and you see that, my debt to income ratio is 50%, 70%, 80%, you got to work on knocking those down. All right, take that income tax, take this surplus check that when you get it, and instead of going to buy a car, knock your debt to income ratio down. If your next month plans, 2 months plan, 6 months plan is to buy a home. Because, like I said, one of the cures of a lean wallet, one of the cures to poverty is buying the home that you live in. And that's what I'm here to help you. But I want to help and advise you in a way that is beneficial to you, that gets you there in such a way that is prosperous for you and for your family and generations beyond. So those are like the biggest difference between them. Your mortgage rate is really going to be dependent upon your debt to income ratio and your credit. That's what it's going to be based on. Now, down payments can make a big difference. Even if you're getting a VA loan, it doesn't mean you have to come to the table with no down payment. Even if your down payment is only $7,000 because you're looking at the 3.5%, you can take more money, find out what it would cost per the loan to buy points. Buying points mean I'm buying a percentage point down. So they may say that, hey, if you give us another $3,000, then instead of 5%, we'll give you 4%, or we'll give you 4.5%, or whatever it is. And you may say, oh man, I don't want to put up that $3,000. But when you look at an amortization schedule over the course of 30 years, putting $3,000 in to buy a point down on a loan could save you $10,000 over the life of the loan. So when you're looking at it from no perspective, which one is going to be best for you over the life of a loan? That's what we have to consider. That's what we have to think about. So I'm gonna give you guys a minute or two for some questions before we go. We just came out here to take a minute and break down the difference between a VA loan and an FHA loan. I will do another video, another live later on this week comparing a FHA loan to a conventional loan so we can understand that one. And later on, there will be videos about how to build your credit to prepare yourself for buying a home. For those who have worked with me as far as building business, they know that there's a different mindset and you do different things if you're building your credit for business purposes than if you're building your credit for buying a house. Buying a house is totally different. That's why that debt to income ratio, totally different when you are buying a house compared to a business. Compared to a business, you ain't worried about you need more credit. The more credit, the better. The more revolving lines of credit you have, great. The more things you're putting on that credit and paying stuff, and you're using it and you're paying it, using and paying it, the better when you're building credit for the purpose of a business. But for the purpose of a home, you want to have some good credit lines, enough that you get a high score, but you want that debt to income to be low in order for you to be able to get the home that you desire. Now, recently, I will say, this is something different. The VA, if you're a first time or you're in good standings with the VA, they've raised the limit to which you can get a VA loan. It's now up to like $510,000 of a home in most areas. If you're in a high cost area, then it's up to like $700 and something thousand that you can get on a home in a VA loan. So the limits have been raised up. They've been raised on the FHA from 300 and something. It's like 312,000 and up to like, I think there's a 740,000. So there's a lot of range that you have. Yeah, the FHA is from 331,000 in the low cost counties up to 765,000 in high cost counties for the FHA. And the limit is $510,400 in the normal counties of America. In the higher markets, the VA, it differs depending upon which market you're in. So if you're living in New York and you're saying that, oh, I can't get a VA, what can I get for 500,000? I want to live in Manhattan. 500,000 ain't gonna get me nothing, and it's not. I need at least 700,000. Well, because you're in Manhattan, you can get a higher one. All right, they'll give you a higher limit. So it is accountable for where you live. What is the criteria to refinance a FHA loan? It's going to be the same criteria it took for you to get the FHA loan. How much money you make, how long you've been on your job, what's your debt to income ratio, what's your credit score, and they're going to run it through the exact same way and just refine that loan to see if you can get a lower interest rate. Actually, when the mortgage rates first dropped about 2 months ago, they dropped, right? because the bond market, the stock market went down, which the bond market, all that money went into the bond market, which caused mortgage rates to drop. But then a bunch of people went and refinanced their homes, and because of the glut of people, the push of people who refinanced their homes went in so much, the mortgage rate went up from like 3.1% to 3.8%. So, and right now I think it's stabilized right around 4.1. So you want to jump in there right now and see if you can, what you can get. You may be able to get something lower, and it may be worth it to go through the process of it. But of course, you're going to have that down payment again. So do you have the down payment of 3.5% if your credit score is over 580? And those are the things that you want to look at. But I'm not a mortgage broker. I'm your real estate advisor. So call your mortgage company or check with you and see what they're offering as far as rates on an FHA loan based on your credit and everything, and how much money you would have to put down on a refi for your FHA. But if you're looking to buy a brand new home, I just want you guys to make sure you have that information of being able to compare the FHA and the VA loan to each other so that you can move forward. One Life asked me, what's the worst financial decision that I ever made? The worst financial decision I ever made was not expanding my company faster. And not expanding the company faster when I knew I should have expanded. That was that was probably the worst one I ever made. Because, I just didn't. I listened to everybody else instead of listening to sound advice. And I didn't expand as quickly as I should have. And if I had expanded, when things had a downturn, I would have been able to make it through that downturn a lot easier. Volume is a great thing. Volume is a great thing. When you have volume, you can withstand a lot. This is why when I am financially coaching anyone, I get them set up to understand getting into at minimum, a 70-10-10-10 plan, meaning that your necessities of life, this is not like your debt to income ratio, but your necessities. Everything it takes to live your lifestyle right now must be below 70% of what you make. If you keep that below 70% of what you make, when you have economic downturns, you're not in the same situation as those who are living paycheck to paycheck. 10% goes into savings, 10% goes into your fund, and 10% goes into your investing. When you're living on a 70-10-10-10, your life becomes a lot easier, and it's like having multiple businesses, because if you take a pay cut, you can handle it. A 10% pay cut won't put you in the poorhouse. A 20% pay cut won't put you in the poorhouse. Not even a 30% pay cut will put you into the poorhouse. You still will be able to maintain your standard of living. You just won't be able to have all the fund money, the savings, and the investment money anymore until you build yourself back up. So it gives you a lot of leeway. I've been in a position where I was down to 50%. I only lived on 50% of what I make. And when the market turned south back in 2008, 2009, I wasn't hurt as much because I was only living on 50% of what I made. Okay? So, just take those things into account when you're building your wealth. It's not about keeping up with the Joneses. It's about doing what's best for you. What's best for you, what's best for your family, and keep moving forward in that avenue. So if there is nothing else, again, my name is Larenzo Reid. I am the proud owner of the Reid Real Estate Firm here in Atlanta, Georgia, in association with Remax Realty Metro Cityside, Remax Metro Cityside in Atlanta. And my goal is to help you to find a home to make that your home sweet home in the best way possible, so that you can really fulfill your dream of owning the home to which you dwell, owning the land that you dwell in. Okay? So you guys have a great day. Remember, you have to free yourself to be yourself, because your greatness is non-negotiable. And let me help you make your home sweet home. Thank you.